Tanvee Gupta Jain from Macquarie now joins us. She is the India economist. Tanvee, good morning. Thank you so much for taking out time for us. Generally, a day after the Q2 GDP data or the print was released, we would have been talking about that. But can you just tell us that the Q2 GDP data which came out, investors will not focus on that because of demonetization, and what happens probably in this quarter will be important?
I agree with you, especially the numbers. If you look at the GDP growth remained pretty good at 7.3% for the September quarter, largely in line with our expectations. But I guess entire focus is now especially on the impact of demonetization on the economic activity. Our view is that economic activity is likely to slow to an average of 6%, which we are expecting over the next couple of quarters, versus 7.2% which we saw in the first half of this year. So the entire focus has to be on how the GDP growth is going to pan out, especially for the next 2 quarters, and then we expect economic activity to start improving from June onwards.
Right. As far as demonetization is concerned, as you say in your report, in the short term it can have a growth disruption, but in probably you expect it to recover also fast. So whenever such disruptions happen, where things just get changed because of laws getting changed, do you think that the recovery also will happen fast, as and when you start seeing signs of recovery, it will be a much faster growth?
Well, I would say definitely this is what our base case scenario is. So we are expecting a temporary slowdown over the next couple of quarters. In fact, our view is that whatever slowdown in economic activity because of cash crunch or the liquidity shortage which we are seeing, we expect it to start normalizing from Jan onwards. So we are not expecting a broad base slowdown because of demonetization measures. And the people try to adjust. So now we are seeing a liquidity crunch, but we are seeing a lot of digitalization or cashless already happening in the economy. And as the printing press is able to print more notes and this currency supply in the economy begins to normalize, our view is that the things will get back into place. Especially if you look at the way we are looking at the India's GDP growth scenario, is that we are saying the lopsided growth recovery shall continue. So while consumption will be the biggest supporter of growth going forward, investment cycle is likely to get pushed forward. Largely we are expecting that the state pay commission awards will start getting implemented from next year. Plus we are saying a 50 to 75 basis point rate cut by the RBI. And lastly, the tax buoyancy and the fiscal windfall gains because of demonetization is also likely to provide support in terms of an expansionary fiscal policy. So in that scenario, the next year or the next couple of quarters, I believe the economic activity will be largely consumption driven and supported by public capex, whereas the investments driven by the private corporate capex are likely to get pushed forward to FY19 in our base case.
Right. In the answer, you also mentioned about any windfall gains coming to RBI. Very difficult to judge how the deposit trends have been, because last 20 days we've just seen deposits surging, and there is still about a month to go. So very difficult to say what will be the sort of windfall gain. It can be way higher than what estimates are. It can be way lower.
I agree with your judgment. So basically, if you look at the the data which was available till November 27, almost 57% of the deposit mobilization has already happened out of the 14 lakh crore which was sucked out in terms of old cancelled notes. Now, yes, there is definitely a more than a month to go, and plus the government has come out with amendments to the income tax law where they are saying that any deposits which was not declared, you can actually pay tax and make it more accountable, which means that the tax buoyancy is likely to pick up. Yes, it's very difficult to ascertain, or there is a lot of uncertainty regarding how much could be the unaccounted income, whether it is going to be 3 to 4 lakh crore, or now the market is expecting it could be pretty low at 1 or 2 lakh crore, and it yet to be seen whether the RBI will be able to show as a reduced liability in terms of gains to the government in terms of higher dividend. So yes, there is a lot of uncertainties, but one thing is sure, that in FY18 we should see a higher tax buoyancy, which will be very positive for the fiscal numbers. So that in that way there will be leeway with the RBI, with the government, to expand the balance sheet to try to push the rural spending.
Right. As you look at, probably the budget estimates, this time around, tax numbers could be quite different. I'm not asking you to predict what will come in the budget in Feb, but the tax numbers that you were building in your model for this year, again, could be very volatile, could be very different because corporate India may see a big slowdown, as even you pointed out in the first 3-4 months.
I agree with you, because now what was happening is that the direct tax collections were lagging behind significantly, but especially your personal income tax collections. But your excise duty and service tax collections, at least the performance we were able to monitor during the months of April to October as per the monthly central government accounts data, is running ahead of the budget estimates. Going forward, because economic activity is likely to slow down, it is going to impact both the corporate tax collections as well as the indirect tax collections. So yes, we will see a lot of volatility in the tax numbers going forward, but said that, we still think the government will be able to achieve a 3.5% fiscal deficit target for FY17.
Right. Till now we had a lot of savings rate which was very, very high, and probably that was got to do with gold, with physical assets saving. Now that this exercise has been done and probably new money would come into the bank accounts, do you expect the financial industry to benefit and a lot of savings to move towards financial?
Well, if you look at the household savings in the economy, 9% of GDP was in financial assets, whereas almost 10% of GDP was in physical assets. But yes, this data is as of FY15, because the data comes with a lot of lag. Post these demonetization measures, and especially with real estate or land sales becoming unattractive because the unorganized segment or the sector is shrinking, I think definitely it is a very good incentive for the households to start putting money into more financial saving instruments, be it a deposit or a provident fund, or be an insurance fund or equities. So yes, as long as the money is in the financial instrument, you could see that this entire hypothesis of higher savings leading to higher investment and higher GDP growth stands valid. Only when the money is locked up in physical assets, maybe in terms of cash in your cupboards, or maybe in terms of a land asset or gold stock in your cupboards, it's actually a dead economy which is not in circulation. So yes, higher financial savings in the medium term should be very positive for overall GDP growth in the medium term.
Right, and it can also create a deflationary sort of an impact, at least in the near term. You expect RBI, you mentioned about the rate cuts that you're expecting, but do you expect RBI to cut deposit or rates the way SBI did, or some of the deposit rates are going down? Can it be a very sharp cut that you are expecting, or do you think it will be slow and gradual as the data comes in?
I would still say it will be slow and gradual as the data comes in. We are expecting 50 to 75 basis point rate cut in the repo. But especially our assumption is at a 4.5% kind of CPI inflation average, what we are expecting over the next few months. Considering RBI has been talking about putting the real policy rate at 125 basis point, and with an expected inflation of 4.5, we do see some more room possible over the next few months in terms of rate easing cycle. But again, we are saying that one more 25 basis point can be possible in the December policy. But again, it's a very close call, because yes, growth is something which needs to get a support, but this is coming at a time when 1 week later you have the FOMC policy. So we are still maintaining or expecting a higher probability of a 25 basis point rate cut in the December policy, and overall 50 to 75 basis point rate cut cumulative over the next 12 months.
Right. Apart from the rate cut, could there also be some, SOPs coming in for industry, because industries may see a slowdown? So can there be other fiscal measures as well, only except rate cuts?
I think for that we need to wait for the budget, because the government has been highlighting that the corporate tax rate in India will be going down over the next 5 years. So it still needs to be seen whether the government will take this as an opportunity to bring down the taxes, which will be incrementally positive for the corporate sector. So yes, it's too early to comment, but I think they will also like to see the numbers after this entire demonetization exercise, which ends on December 30th, as well as the tax buoyancy, which is expected from the income tax declarations, higher tax compliance because of this declaration scheme. I think they will still need to look at the numbers on how the fiscal math is going to shape up going forward.
Right. So, one is, of course, the part that we just spoke about, that, how this can change things. If there is a windfall gain, it could help budget, it could help taxes come down. And second is the implementation. Till now, the supply of money has not been that great, or probably, the rotation of money has not been that great, which has led to some sort of supply issues. How would you look at this easing out? Do you think it will take a while before the supply of money eases out? Only after then we can see a trend in the economy?
See, if you look at the currency in circulation, is roughly around 12% of GDP. So when we say India is the most cash intensive economy, yes, because 12% of GDP number is pretty high in terms of cash, whereas most of the economies have cash as a percentage of GDP somewhere in the range of 8 to 10%. So if we expect RBI to let the currency in circulation back at 12% of GDP, I think that will be very overly optimistic, because the entire idea of demonetization was to encourage cashless or digitalization in the economy. It's not that India will start moving tomorrow towards a less cash economy or completely towards mobile banking and digital, but yes, I think it's a step forward. So our view would be that instead of 12% of GDP currency in circulation, the RBI might be comfortable with a number somewhere around 9 to 10% of GDP in terms of currency in circulation. In terms of printing on notes and that availability, we are expecting things to start normalizing from Jan. Our base case assumption was, even before the demonetization measures come into picture, the printing of notes would have started sometime in September. And we are not expecting the supply of currency to be exactly matched to the amount which is being sucked out. So the view is that at least the amount which is needed for your essential consumptions and for your daily needs to be back into the economy from middle of Jan or end Jan onwards, even though things to become much better off from March, April onwards. So yes, from likely our base cases from June onwards, economic activity should start improving. Till March, I would say yes, things will be better off than what you will see in the December quarter, but it won't be as good as what you were seeing pre-demonetization measures came into the picture.
Right. In terms of just a word on oil and what's happening over there, you're an economist, you tend to, try and work with budget, what's happening to oil. The street has been talking about oil prices going up, but at about $50-$55 a barrel, you would still not be worried. What will be that number till when you will not be worried about what happens to oil and the sort of imports that we have to pay for?
We are taking a Brent oil assumption at $60 a barrel for next year, that is FY18. So this was already, we had priced in our numbers. I think somewhere around till 60-65 we are fine. Anytime beyond $70-$75 is definitely bad for India, because we are a net oil importer. But yes, the sensitivity for oil, especially in terms of oil imports or current account deficit, is high, because every $10 increase in oil prices increases our current account deficit by almost $11 billion, which is a huge number. So yes, India is at a disadvantage if oil prices go up, but anything around 60 we are not so overly worried, because the domestic demand in the economy is still weak. So I think, and even if you look at the capex cycle or the capacity utilization is still at 73%. So I think that will try to offset some of the pressure on the demand, but yes, anything over $70 a barrel, I think we will be worried. So far, so good.
Right. So till $60-$65 average, as an economist, you would not be worried, and only after 70 you would start to change your estimates. Thank you so much, Tanvee.